It's the SawCast, where real people speak that real shit on real topics every day. And I go by the name of Stevo.
Ariel, what the fuck you do, y'all?
What's happening?
This week our topic is debt.
That.
Yeah, so it's 2025. Happy New Year, everybody.
Happy New
We
Year's.
want to make sure that we are all ready for 2025. We
We
need to
gonna
get some,
conquer it,
get some of that debt off.
Right,
You know
get
what
some
I'm
of that
saying?
debt off. Less debt, less stress. You know what I'm talking about?
So we taught y'all niggas how to budget. We taught y'all niggas a little bit about investing, but one thing that's gonna get your pockets a little bit more fatter so that you can invest a little bit more is to pay off some of them debts.
Bro.
You know what I'm saying? Because honestly, a lot of that debt is like going towards your expenses.
Yeah.
So, you know what I'm saying? You can get rid of that if you pay a little bit of it off. We're gonna tell you, any like different ways that you could do it, but ultimately it's up to you and how you want to do it. But we got our own ways, and we want to share that. Other ways people have taught us and things that we have read. I will say a big proponent or a big person that we really like when it comes to debt is Dave Ramsey.
For sure.
The GOAT.
Because he give it to you straight cut and dry, you know what I'm saying? He ain't trying to remix nothing. He like, look, pay this motherfucking debt off with your broke ass. And people need to hear that. They need to hear that.
Yeah, he like, why you going shopping?
Right. He like, yo, you broke as hell. Why you going shopping? He like broke ass.
Because I mean, a lot of times with debt, like we don't really recognize that we're actually paying to old people. So it's like you kind of want to get that off if you can. So
yeah, sooner than later. You know what I'm saying?
Let's get into it. So what's
We
debt,
getting into
Stevo?
it. What is debt? You
Yeah.
know what I'm saying? Debt is usually, you know what I'm saying, something that you owe somebody, right? It's amount of money that you owe somebody else, usually a lender. You know what I'm saying? That's what debt is, kind of I said a set amount of money, right? So it's a set amount of money that you owe somebody, right? And so you are the borrower and they are the lender. So that's what that is. Like credit cards, like mortgages, what's another one? Credit cards, mortgages, when you have installment loans, that shit's
So
debt.
many
You
times
know what I'm
of that.
saying? That's crazy shit with it.
Yeah. So, and then we might as well just jump into what's the types of debt.
Yeah,
You know
go
what I'm
ahead.
saying?
Just bless them with the
Okay,
first
so the first one is revolving debt. Revolving debt is
one. Right, revolving.
is revolving. So it means you have a debt that you have to pay to a company, kind of like a credit card, where every time it changes how much you owe, but you have a set agreement with that lender, and that every month you're going to pay a certain amount, and you normally have a cap that you have on the debt. So like with a credit card, you have a cap of $1,000. You know what I'm saying, on your credit card. That means you can spend up. Well, they loaning you up to $1,000 a month to use, and then as maybe you might not spend $1,000 that month. You might only spend $500. So your interest on that debt might only be will only be a certain amount that month, but next month you might owe more. So then your set amount of how much interest you got to pay changes. So revolving is just basically revolving,
Right, continuous debt. You know what I'm
debt
saying?
that you have with a loan with a loan officer or a person that's willing to give you a loan.
For sure. Then you got the secured debt.
Yeah.
That's like when you borrow debt and then you giving up something for collateral, like car loans. You know what I'm saying? Those are secure debt loans because you have to give up something like as far as collateral. So the reason why you got to give up something for collateral is if you do not pay that debt in the sense of default, then they take whatever collateral you put up. So that's key. In a secured debt loan, you got to pay attention to that because sometimes people don't pay attention, and then they're what they have as collateral, then they don't pay it, and then they take that collateral. So pay attention to all of that, and with car loans, I mean, usually as long as you pay it on time or you talk to them and discuss payment options with them, sometimes they can be lenient. So with those collateral loans, a lot of times, since they know they have something up for collateral, they usually are more willing to work with people, with those
For sure.
with those kind of loans. You feel
Yeah.
me?
All right. An unsecured loan is a loan where the lender trusts the borrower borrower. I can't even say borrower. When the lenders trust the borrower to pay them back, normally you have to have good credit for those type of loans. You know what I'm saying? You have to have some trust with that lender. You know what I'm saying? And like I said, credit is very important because that allows you to get um, debt or that allows you to
That at a
acquire.
better rate. Yeah,
I
that with
mean,
better interest rates. You know,
and yeah, and then when you get that sometimes with better interest rates, then you don't have to
pay
pay
as
a lot of
much.
back.
Right,
That goes into our budgeting podcast.
right,
You can bring them expenses down.
for sure.
You know what I'm saying? And we wanted to do the debt podcast so we can make sure that, you know what I'm saying, when you're getting financial education, you're being more financially literate, you're taking into account your debt. That's the only way in order for you to get farther too as well because we can do a budget all we want to, but if we keep on getting debt,
Right.
then we're not going to get anywhere.
Yeah, and
And then you
then
keep putting secured loans on your shit, and then you putting.
right, you keep having collateral,
I'm
so
saying you keep on
they
you
taking
putting
your
your
potential
assets up
asset.
because
Right,
they want like they want your biggest asset.
for sure, and they coming for that first.
Yeah, and there's no way you can not give it to them. So
Yeah,
yeah,
legally, legally. But and
go
then with
ahead.
the secured, with the unsecured debt, usually they're smaller amounts. That's why they're like gym memberships and things of that nature because they trust you because it's like, it's a little something. Like they'll come after you, but they don't come after you aggressively as a person with a secured debt which has collateral, on there. So they're coming after that because they want something in return. Because usually, especially with the cars, when you got that collateral, then you don't pay that back, and you get your car repossessed. Boom. Then they possess that. Then they gonna sell that car. They gonna fix it up a little bit. Sell that car probably for the same amount that they gave it to you. Now they got another motherfucker who paying the same amount or more than you was paying, depending on the time and day, in the market and how everything's flowing. So, yeah, it's most important to, like we said, we just continuously reminding everybody with these finance podcasts that these are the things that you need to do to be successful, and discipline in all these areas is just going to accelerate you to the next level financially.
For sure. So the components of debt are your principal, your interest, and your payment. Your principal is the amount that you are loaned. Your interest is the amount that you have to pay back to the lender on the loan, and then your payment is your principal is a portion of the principal and the interest that you have to pay back.
Absolutely.
And so, when you are thinking about your components of debt, or if you get into any type of debt, you need to make sure that you're planning out how much you have to pay. You know what I'm saying, versus how long the debt is.
Right.
You know what I'm saying. Before you take it on, because sometimes you have to pay a lot more interest than the actual. Well, every time you have to pay more interest than the actual debt that you actually had. So I think a major thing that you want to do always is when you pay your payment, you want to always pay another payment towards the interest. It don't matter if that's $20. It don't matter if your loan is $100,000 and you want to put an extra 20 some, 100 some. Any extra payment towards your principal is going to bring your loan balance down, and it's going to reduce the amount of interest you have to pay.
Absolutely. And then another important component is APR. You know,
Well, that's the interest.
right? But it's
Annual
a
percentage rate.
yeah, annual percentage rate, right? That's usually like credit cards, right?
Yeah.
And see, and that's why credit cards are, you know, kind of like riskier, I would say.
Yeah.
But one thing about that percentage is you were mentioning your credit score earlier.
Hmm.
And when you have a better credit score, not typically, more than likely, you're going to have a lower interest rate. And now, when you were saying that over the longevity, right? That helps you over the longevity when you have a lower interest rate because you're not paying as much on that loan. And then when you were saying that principal, see, that's a tip right there that she was giving y'all. She dropping the gym, you got to pick it up. And that gym that she dropping down is a lot of time you have that interest and a lot of time you have that payment. But then if you pay towards the principal, you're paying off your
Actual loan.
right, you're paying off the actual loan. So since you're paying off the actual loan, then it's helping you in the long run because you're paying off the actual loan without the interest. Because once you're paying the interest, it's going
strictly towards the lender.
Right. It's going. The interest is going strictly towards the
And that's
lender.
extra. So with every loan or with every um, amount of debt that you get from somebody, that principal is how much you actually got from them. So
Facts.
any amount of interest that you occur or accrue, I guess you could say that, any amount of interest that you accrue is going directly towards them. Like it doesn't benefit you at all to give them interest. And the longer that you stay into a payment plan, the more money you're giving them that they don't even deserve. Because to be real, when you get a loan, how much you're supposed to get back is what I feel like what I gave.
Facts.
So like giving them more than that, sometimes even double the amount of the actual money that they gave me is crazy work. So you
And
definitely need to be paying that shit down.
I'll say this as well: when you pay on the principal, it doesn't have to be anything ridiculous, right? People think, oh, I got. You don't have to pay an extra payment, an additional payment, nothing like that. Um, but when you pay on that principal, make sure you're paying something towards it, and it's a separate payment. Make sure it's
Yep,
principal
from you.
only. You call them or contact them or go through your app or service or website and make sure you like. I just want a principal only payment. That's what's most important. Is principal only payment, and that's after. That's an additional. So you're gonna pay your whatever is due, right? But then that additional principal payment is what we're talking about, and it also shortens up your loan because you might have it. Let's say what's a common when like 48 months, 56 months are two
Car
common
payment.
periods, right? Are two common periods, right? Where people have loans over, and you can pay it in a shorter amount of time because you paid down that principal, and now that principal is getting paid down. So now when that debt is getting paid down, so your overall is getting paid down, so you're getting taxed less because you don't have to pay as much because now it's not as much that they taxing you on.
Yeah. So we feel like the three worst forms of debt is payday loans, title loans, and credit cards. If you
Sheesh.
got any of those three,
Sheesh.
you need to be working to get those paid. But we're gonna talk about the ways you can do that later, but those are the worst. Now, a title loan is what the security loan, like
Yeah.
where you got to
Collateral.
put your car up or your house up for
Right.
a loan.
Man.
That's crazy work to me. Like if you only are getting accepted for title loans, you need to do what you got to do to get your credit right.
Right. That's when
Don't
you
even try
need.
to take no loans out. If the only thing you're getting is secure loans, that means your credit ain't right and you need to go back and try to figure that out. Do not be getting a whole bunch of title loans and stuff like those are the worst loans and they do like it first of all, they got their secure loan, so they got your house or your car in the chamber, and then on top of that, you're giving them interest, and the interest is normally like 100 and something percent a year. Like you need to pay attention to that. Like when you're doing, like when you're calculating your payments, you can calculate your payments. You got to break the APR up into 12. That'll tell you how much interest you're putting on your payment. I mean,
Facts.
how much of your
Yeah.
payment is interest. You know what I'm saying? So if you're not if you're not able to get anything outside of the scared, don't get it. Like I said, those title loans, them motherfuckers is like
Maybe eating people
a
finances
hundred and
alive.
something percent. So that means if you like when you your first payment is mostly interest. That means it's not
Yeah.
even going towards decreasing your debt. It's just going straight towards their pockets.
And them payday loans too. You know what I'm saying?
The payday loans is normally like 2 weeks, and you can get stuck in a cycle because if you borrow too much of that payday loan and you borrow at the wrong time during the month, then you might have to reborrow, and then you in this cycle you can't get out because you didn't. That loan should be used. You should only get a amount where you only should get a loan of the amount that you have free on that next check. If you get more than what you got on the next check, then you're gonna trick your finances into thinking you got more money than you actually do.
Facts.
The only take the payday loan out on the extra money that you got on the next check. Period. That's it. If you have to do it, because sometimes you got to do it. And payday loans to me is Klarna, Cash App loans.
Hmm.
Um, what's the other? It's like Cash App. Uh, it's like
Cash app.
it's another like Cash App type of credit card.
Like PayPal. You talking about?
PayPal, you know what I'm
PayPal.
saying? I wouldn't talk about PayPal, but
But all
PayPal
right.
too. But yeah, like Apple credit, like any of that, like you do not need to be taking them short term loans, like I said, because it inflates your income. It makes you look like you got more money than you do. You don't have that.
All right, and then the credit card. Number three is credit cards,
Put
right?
oh when you do, if you do ever get a small term loan, you need to put that in your budget immediately. Put
Not
that
for
in your
sure.
budget before you get it for real. See if you can even do it.
Not for sure. And
You
then
said credit cards.
credit card. So credit card loans. See, now the APR is what you have to pay attention to with credit card
Yeah,
loans, right? Because the APR is like usually the average I would say is like 24%.
for sure.
So that's what you're getting taxed yearly for taking out that loan from that
A credit card
credit
is a
lender.
loan.
So yeah, it's a loan. I think that we have to reprogram ourselves into thinking that that's money that we have, because you can't think that that's money that you have. It's money that you don't have, right? It's
That is not an investment income that you
no,
made. That is not a loan. That is money
that's
that
not
is
residual
loan. Let me
income.
residual income. That is just money that is loaned to you.
And honestly, it's a trap for the consumer. Let's be real. That's just a trap for the consumer, and now the consumer has to be smarter than the average, right? Because if you're not smarter than average, you're gonna get caught in every fucking trap that they got for you. Now, the consumer, that now the class, I would say, quote unquote, the middle class, right, is the ones that they get with the credit, because you have more money than somebody who's struggling, but then you don't have as much as the motherfuckers who got it, right? So now you in between. Now you trying to do a little bit more. You trying to go on a couple more vacations. You trying to like pay shop a little bit more. You know what I'm saying? And those are bad habits, right? Only buy what you can afford, right? And if you do not have it after bills, that's why the budgeting podcast was so important, right? Because you allocate and see what you have for personal. Now, if your personal funds are deficient, if you do not have any more personal funds, do not take that credit card and go spend it, because what will happen is that will become a habit, and then that's a bad habit to have, because then you're going to continuously have that debt, and then you have 24% um, on average that you're paying to that credit lender per year, and that ain't doing nothing but eating up all the change that you can invest. So don't get too carried away with them credit cards. I would say like this: the best way to use a credit card is for like bills, right? Because the points is decent, right? The points on the credit card, they be adding
They
up.
are
They be
actually
decent.
decent.
You know what I'm
They are
saying? They be
actually
decent,
decent. Yeah,
especially if you get the right one, right?
yeah.
So the credit points and everything be decent, but you gotta make it make sense to your scenario. If all you can put is a little what we say, a rental insurance, something like that, or your phone bill on there, gas, groceries, things of that nature should go on there. Those are the best things to put on your credit card, because they usually are not that expensive and are easy to pay off.
Real for real. So it says so. I mean, honestly, I feel like you should start paying off your debt like as soon as you can. If we talk about timelines, as soon as you can, you need to pay off. If you have any of those three, for sure, you need to pay those off first. Like, so we got our own method, SawCast, of how we like to pay off debt. But I will say, with these three types of debt, that is so important to pay it off. So if you got those, you need to pay them off immediately.
Yeah, first things first.
Immediately,
First things first.
because you need to get those gone, because those can mess your credit up. Like as soon as you miss a payment with any one of those type of loans, they're gonna go straight to the credit bureau and your credit is gonna be shot down. Even if you go and dispute all that stuff, you gotta do all that stuff afterwards when you could have just avoided it altogether. So if you got any of
Absolutely.
those, you need to do it immediately. But we do have a few ways where, you know what I'm saying,
To pay
shout out
off
to
that.
Dave Ramsey, you know what I'm saying, that you can pay
Snowball.
it back.
For sure.
Okay,
He
so
definitely a major component of the snowball method, right?
yeah, so the snowball method is when you pay off your smallest amount of debt and then you make your biggest. Now, we going back to the budgeting podcast. You need to write down every single type of debt that you have at first. Watch the budgeting podcast first. After you
Facts.
write down everything that you have and everything that you have, because if you got debt, then you have to pay that every month or however often that you got the debt. So that should be in your budget already.
It should be
So
a
make
bill.
sure you write it down. So the snowball method is whichever one of those is the smallest, that's the one you pay off first. And so you can go biggest. Now the reason why that one is a good, well, for to me, the people who that's good for is for people who like instant gratification. Like, okay, I paid off a little. You feel better about yourself. You can keep moving. You know what I'm saying? Then with that snowball method, you take that small amount that you was paying toward that small, put it to the next one to pay that off faster. Then you take that next one, put it to the big, put those payments to the bigger one. Like, you know what I'm saying? As you paying things off, you need to be taking the money that you was paying off the last one and put it towards the
And
next debt.
and for all y'all that need examples, let me do this.
Okay.
So let's go with the three common ones, right?
But
Three. I said three common ones, right? Just for example, mortgage, um, car loan, credit card.
okay.
So say your credit card payment is 100. Let's say $100. That's your credit card payment. Your car payment is nowadays what's average, like $500 average, $500, and your mortgage is 18, right? So with your credit card being the lowest one, right? That's the one that you want to pay first. So then you pay the minimum on the other two, and then you're paying whatever you can on the
Yep, the
lowest one.
maximum.
The
Yep.
maximum on the lowest one. So the maximum after, so the minimum on your mortgage, minimum on your car payment, and then the maximum of your money that you have left over after bills, that's what you pay on that one. So then it goes down gradually, it goes down gradually, and eventually it disappears. Once that one disappears, then your next one, which would be your car payment, then you pay that one, and then you minimize, and then you still do the minimum on the mortgage, and then after your car is paid off, then all that money that you had, um, then all that money that you had for those two that's still available that you were still paying on those, that's what you pay towards the mortgage, and then you pay that one down. So for all you that need examples out there, that's a quick little example for y'all for some common numbers that most people probably have.
Okay. And then we got the avalanche method. The avalanche method. The avalanche. Then we got the avalanche method. The avalanche method is where you pay the biggest debt that you have, and then you go into the smallest one. So that's the one where you go hard on your house first, and then you pay off your house, and then you know what I'm saying, you pay the other two minimum, like you pay your credit card and your car minimum, but you pay the most on the house, and then you get the house gone, and then you'll have a whole lot more money to pay off the car. Then that should be gone after that, pretty rather quickly, and then you pay off the last one rather quickly after that. So those are for people to me who got a little bit more patience, who wants to secure their biggest asset more than the smallest one. You know what I'm saying?
Yeah.
Because credit cards might not be that serious to you,
Right.
even or if you're a person who pays off their credit cards altogether every month, then you can
Facts.
definitely do the avalanche method. You could definitely pay the biggest that you got off and then go from there. And then, like I said, that just makes it easier to. If you do an avalanche, then that makes it easier to pay off all the rest of them after you pay that big one. So it's like you pay the big one and then that disappears, and then all of a sudden, the other two will disappear even quicker. You
No,
know.
for sure. But then some people go with the consolidation method,
Hmm.
and that's when, usually most times I see this is when people have like a student loan, and then they consolidate their like if they took several different like student loans, and then they consolidate those loans together, and then they just pay off that grand amount. That's usually when I see, it, and that's for people who like all of their debt in one space, and then you can pay it off, there, because all loans can't um always be consolidated, but if you can consolidate, then those are for people that want just some debts to be all together, and then they can just pay it off all together, and they don't have to worry about that.
Yeah.
So
So a common consolidation that happens with debt is like student loans. Like when you have student loans every year, it's a different loan. It could be from a different company or a different servicer. And what they'll do is take all of those loans and put them all together. And then you'll have one payment instead of when you paying your student loans, you paying a little bit on each loan. Instead of paying a little bit on each loan, you pay one big payment for all of them all together.
and it's most commonly seen with like federal loans,
Hmm.
because a lot of the federal loans are separated by subsidized, unsubsidized, or if you took this subsidized loan and in this semester or this unsubsidized loan in that semester, they're technically different loans from the same lender. So those are usually the most common ones are like federal student loans.
Yeah, so the SawCast method is what me and Steven did, which was we pay our assets first. Like
Yeah,
whatever our biggest assets that we have at the time, that's what we gonna pay off. So for me, um, I paid off my car a few years ago. And how I did that was, I would say I would say the avalanche method. I guess I'd use the avalanche method
right.
because I'm just not thinking about student loans for real. But because I feel like student loans ain't, to me, like I said, the SawCast method. We prioritizing assets. You know what I'm saying? So like student loans aren't necessarily going to give me any assets or anything, and it's one of the forms of debt that's not that bad compared to the other ones, and it's not going to prevent you from moving around as far as like with your credit and things like that.
For
So
sure.
prioritizing first was my car because I don't own a house, so it was the car. And so every time I got a little bit extra money from anywhere, I would put it towards the principal on my car, and I would do it. I kept doing it week after week, even if it don't matter where I got the money from. I know sometimes it being an adult, you get money from anywhere, like just random places, like money
You
will
might have
come
a
up.
little hustle and bustle.
Yeah. So anytime you get a little extra money, I paid that extra money towards the car, and that it eventually went away, and it went away pretty quickly. So yeah, with I would say the same thing. Like even if me and Steven get a cell phone from like T-Mobile or something like that, we gonna pay that off. Like that's gonna get
Quickly,
paid off
swiftly,
faster.
like Taylor.
Like furniture. Like if I go get me some furniture, I'll take a loan out on it. Like 90 days, I'm paying that shit off in 90 days. It probably be 60. You know what I'm
Right,
saying?
right.
Because those are all things like when I sometimes I have moved as being an IT person, and having um owning my furniture and stuff like that. I can sell that, give it to somebody else, something like that. I make sure I take care of all of my assets. That's one thing that you need to do so that if you ever have an issue, then you can get rid of your assets pretty quickly. I have no problems ever getting rid of my furniture because I always take care of it and I always paid it off. So it's always helped me when I had to move somewhere else. So that's something that you can keep in mind as well. So we always pay our assets first. You got anything to add to that?
Um, yeah, because I feel like it's important to pay your assets first because a lot of times they depreciate, right? Some of them depreciate, some of them appreciate. But for the depreciating assets, like we said, like the vehicles, it's very important because you'll still have more value as the time goes on, right? I mean, they'll still hold more value in a short interim time, right? So if you pay it off sooner, it'll still be more valuable. So sometimes you might have to liquidate your assets because um, a life emergency or something might have came up, or you might just want to switch the flow, or you might want to liquidate that asset because you don't want to do the trade in value because that didn't make sense to you. So okay, you don't want to trade in your asset. I mean your vehicle, which is an asset if you after you pay it off. So it's a liability before, but it's an asset after, right? Okay, because it's paid off. You don't owe no money on it. So the thing is, what I'll say about that is, with the car, so you make sure that you pay that off, and then once you pay that off, and then it becomes an asset, and then now you have the leverage of the value of the vehicle, right? And then sometimes you, like I said, you might have to liquidate, and if you can't liquidate, then that's why it's easier to pay the assets off because if you don't own those assets, then that is just something that you have in your possession that you can quickly boom liquidate it, boom get this bread off it and move it around.
Yep. So that is the best way to us to pay off your debt would be to pay off your assets first. To me, that's the only way that really, to me, what we are promoting when we're talking about financial literacy and freedom is freedom. Like we
The
care
freedom
about
portion,
financial freedom.
financial
You know what I'm
freedom.
saying? We want to be able to move around, do whatever the hell we want to do. And so, in order for you to do that, you need to make sure that your assets are paid off or you're going to be stuck somewhere. You
Right,
can be
your
stuck somewhere.
assets and your debt is paid up because if you owe somebody, then your money can't work for you. You know what I'm
And I
saying?
will say that one thing that you guys can make sure that you pay attention to is when you are paying off, if you are paying off any assets, especially big assets, you can take that off of your taxes too. That's another um, That's another good thing about paying your taxes first and doing it the SawCast way, because you
Right.
can take it off your taxes. So you can do your depreciation, you can do interest, all that stuff can be taken off on your taxes and rolled off. So that's the way to do it.
Yep, and
And it's the
and
SawCast.
it's the SawCast, and we appreciate y'all for rocking like cutoff stockings as always.
Yep, and like, share, subscribe. Like,
Like, share,
share,
and
and subscribe
subscribe.
to our channel. Make sure that y'all always are sharing it. Make sure y'all letting motherfuckers know that we doing something positive over here on the SawCast.
Right,
And
for sure.
yeah, pay off them debts.
Pay off
If
that debt.
not, go to the Budget Podcast. If you ain't seen the Budget Podcast, go look at the Budget Podcast. If you, which one should they do in order? I would say
Budget
definitely
first.
they in order. Shit, do the investment one so you can learn about investment, so you can see how that's gonna help you. Then you'll start by doing your budgeting, and then you'll come and
Nah,
then.
budget. Fuck what she talking about. Budget, goddamn.
I mean, you
Budget
should budget,
podcast.
but
Budget
you think
podcast.
that first?
Yes, because if you don't budget your goddamn money, how you know what you got to invest?
True, but
But nothing.
if you're not doing either, I feel like if you like, why do I need to budget so that you can invest and make more money without doing nothing?
Hey,
So that's the okay. To me,
budget.
this is how Aerial Stevo
Budget
do it.
B.
Invest,
Budget B. Invest I. What
invest,
comes in the
find
alphabet?
out why it is a good reason to budget, which is from the Investing Podcast, so that you can have money without going to work. And then, you know what I'm saying, make sure that you learn financial literacy first. The basis of financial literacy is budgeting. So that's why Steven said go there first. That's the basis of financial
Right.
literacy.
Build your
And then
foundation.
and then this kind of goes hand in hand with budgeting, because you need to put those expenses from the debt on your budget.
So I would say this. I would go to. So that's what her
Yeah.
synopsis is. My synopsis is, you should go to the budgeting podcast first, because if you don't know what you have, you don't know what you have to spend. You dig me? So go to the budgeting podcast first, and then you're going to go to the debt podcast, which is this one, right? And then because you're gonna budget, and then you're gonna figure out how to pay that debt off, and then you're gonna invest, because it's best to pay your debt and then invest. But if you're a person that want to do a
I do
little bit of
both.
both, you know what I'm saying, you could do a little bit of both. But I'm just saying, in a perfect scenario, budget, debt, invest. And
I
it's the
would-
SawCast.
I mean, it's the sarcasm, but I would say I was gonna add a little bit more to
What
that.
you gonna add? A little
I'm saying,
paprika?
like, I feel like, you know what I'm saying, as far as investing is concerned, you know what I'm saying, I do both. I pay off and invest. I feel like you can miss a bag if you just 100% paying off your debt. So I feel like you definitely need to pay attention to investing. I mean, pay attention to all of them. Watch them all, nigga. You know what I'm saying? This is sarcasm.
And it's the SawCast. Appreciate y'all for rocking. You heard me? See you next week.